So welcome back everyone. Now in this part we are going to start with question number 12. In that we are going to discuss about the interest rate futures as well, but that also includes the forward rate agreement. So I will start the question, we will complete the forward rate agreement part, and then we'll shift to the discussion for interest rate futures. So we are going to go along with the questions itself. Have a look on question number 12. So this is the question in front of you. Electra Space is a consumer electronic wholesaler. This is a company. The business of the firm is highly seasonal in nature. Seasonal means what happens is that during some period in the entire year, they will see a lot of customers, and then there will be some time in the year that we'll call it as off season. No customers are coming to the shop and all that thing. So this business of the firm is highly seasonal in nature. In 6 months of a year, understand, firm has a huge cash deposits, and especially near Christmas time and other 6 months firms has a cash crunch. So this is what happens for the for the last 6 months there is a huge demand for the products of the company, and there is a huge sales are also huge. And at that time what happens is that a lot of cash can be found in the company's bank account. But what happens in the first 6 months of the year, company faces a situation where they have to borrow money from the market. So there is a cash deficit in the first 6 months. So they face a cash crunch in the first 6 months. So this is what happens, leading to borrowing of money to cover up its exposure for running the business. And it's very simple that if you are facing a situation of cash crunch, you will have to borrow money from the market. That too only for 6 months, because for the last 6 months you will have money from the sales. It is expected that the firm shall borrow a sum of 50 million for the entire period of slack season in about 3 months. What does that mean? It means that right now, let's say September is going on, September ending is there. Right now, let's say you are standing at this time, 30th September. So in order to complete this year, October, November and December are going to be the coming months, and then the seasonal time will get over. So after 3 months we will complete our seasonal time, and the slack season will start for 6 months from January to June, let's say. So that's what the question is saying, that company is planning to borrow 50 million euros for the entire period of slack season. This is the entire period of slack season for 6 months. But that 6 months slack season is still 3 months away from this date. So that's why they are saying that after 3 months we are going to borrow it for 6 months. So in order to look at FRA, it will start after 3 months and it will end after 9 months from today. So the starting and the ending date, just mark it down. This is the starting date and this is the ending date. This is just 3 months away and this is 9 months away. So from today, the slack season will start after 3 months and the slack season will end after 9 months. So this particular FRA is applicable for us. This is how you should interpret. If you're not able to interpret this now, then you will not be able to take the rates, and you will end up putting some blind logic, and you will end up taking a wrong rate, and that's where you will not get the marks. So you should be very careful with that. Also, this is the bid rate as we discussed in the previous question. This is the ask rate. Previous means the question where we learned about the arbitrage. So what is bid and ask rate? At this bid rate, bank will buy money. Bank will borrow money from you. And at ask rate, bank will lend money to you. So you want to borrow, right? You want to borrow. Company wants to borrow from the bank. That means bank will lend. So the rate applicable will be 5.94. Am I right? This is how we have to pick the rate. So it takes a lot of knowledge, conceptual clarity, just to make sure that we are picking a single rate out of those 6 rates given in the table. The moment you choose a wrong rate, the entire answer is wrong. It doesn't matter what you're doing afterwards. Okay, a bank has given the following quotation. So have you understood the concept of 5.94%? Why 5.94% is applicable to us? First of all, the FRA that we are looking will start today, end after 3 months. FRA will start today and end after 3 months, and the moment FRA will expire, the loan period will start and it will end after 6 months from that date. So 3 months to start the loan period and 9 months to end the loan period from today. That's why I was able to write down what kind of FRA is required to me. It was 3/9 FRA. After that, I knew the concept of bid and ask. I knew that the bank will borrow at a lower rate and lend at a higher rate. That's why the bank is sitting there, na? Their only business is to borrow from one hand and lend it to the other hand. And the difference between the interest rate is their profit, is their business. So 5.94 minus 5.64 is their business, is their profit. So we want to borrow money from them. They are going to lend us at the lending rate or the selling rate of the bank. That's 5.94. Now, 3 months, this is related to interest rate futures. 3 months, 50,000 future contract. You understand, in futures there is a lot size. This is also expiry. Now, let's write down. We'll start with the interest rate futures concept here. So let me put a heading as well. Three months from now, we will need a loan for 6 months of slack season. So if you go for FRA, you need 3/9 FRA, right? This FRA will start here and end here. Do you understand that? Because afterwards borrowing will start here and end here. So anyhow, the derivative agreement that we are entering into today is expiring after 3 months. So we need a protection for these 3 months. Understand, this is the loan period. Nothing will happen after taking the loan. So before taking the loan, the entire risk is there in the market, and that's why we are using the derivatives. So this is the period for which we need the security. We need to hedge the risk. And for the same period, 3 months interest rate futures is also available. It will start here and it will end here. Okay. So 50,000 is the lot size, 3 month is the expiry. Future contract maturing in a period of 3 months is quoted at 94.15. This is the price. This is the percentage. We'll talk about it. You're required to determine. Let's first focus on the FRA part only. How an FRA shall be useful if the actual interest rate after 3 months turn out to be 4.5 and 6.5. See, the question is not asking for settlement amount. So I was saying that the question is not asking for settlement amount. They are saying that prove that the hedging has been done. So let's do the calculation. It's very simple, sir. I think I will come directly to this part. This is the first part which explains only about forward rate agreement. So nothing of interest rate futures is included in this. Now understand, by entering into an FRA, firm shall effectively lock in interest rate for a specified future in the given it is 6 months. Since the period of 6 months is starting in 3 months, the firm shall opt for 3/9 FRA. I told you about this. Locking the borrowing rate at 5.94%. This is the selling rate for the bank, because we want to buy, bank will sell, and the rates are given according to bank's angle. So looking from the bank's angle, 5.94% should be the rate. In the given scenarios, the net outcome will be like this. Now understand that you have fixed your interest rate, forward rate as 5.94%. That means whatever might be the rate on the spot, your cost will be 5.94% for sure. So understand one thing. In the first case, 4.5% will be the actual rate to borrow money. But the difference between 5.94 and 4.5 will be your loss that you will settle in FRA. So 4.5 and the difference between these two, both of them will be your outflow, resulting into a total outflow of 5.94. Anyhow, the difference will also be an outflow. 4.5 will be an outflow to borrow the money. Both of the total of both will be 5.94. Understand? I will get back to the table. Now, when you pay 6.5% in the spot market to borrow money on that date, in reality, you will borrow money at 6.5%. Since you are paying more interest than agreed, the balance interest will be paid by you paid to you by the bank. So this will be an inflow. The FRA settlement will be an inflow and interest will be an outflow. Net totaling, or we can say total of both will be 5.94. Ensuring that in any case your outflow should be fixed and it should be this much. Have a look. If the market goes to 4.5%, the rate fixed is 5.94%. What will happen in reality is actual interest rate to borrow. On that date, in reality, you will go to the spot market and you will borrow money at the spot rate, which will be 4.5%. Okay. But there will be some loss or gain to you. There will be some loss or gain to you in FRA. And in this case, there will be a loss. Why? Because you are getting a lower rate of interest in the spot market, but you promised to pay 5.94. So the difference has to be paid by you to the FRA party, FRA seller. Since you borrowed FRA, you had a buy position in FRA, right? So 1.44 will be paid by you. This is the cash outflow. This is also a cash outflow on the principal amount. So FRA payment or receipt, 50 million into 1.44% into half. Half means for 6 months only you are borrowing. So these are per annum rates, sir. These are per annum rate. Understand that you will pay interest after 6 months to the bank from whom you borrowed money. You will also pay FRA loss after 6 months to the FRA seller. Both, the total of both will be the 1485,000. In this case, there is no requirement for the settlement since you are not settling the FRA. There is no FRA settlement in this case. You are just making sure that the bank is paying, bank is getting the interest and you are paying or receiving the receipt or payment from the FRA party. So settlement is not the purpose of this question. That's why no discounting is done in this question. The purpose of the question is to prove that 1485 divided by the principal amount converted back to the 12 months, because this is for 6 months, should be equal to the 5.94%. That's the same. Just a second. So it should cost you 5.94. In the second case, if the market is 6.5%, just understand once again, you had agreed for 5.94%, but the actual rate that you will pay to the bank as an interest is 6.5. You are paying more to the bank. You will get the balance amount as a gain from the bank, from the FRA seller. So the net of these two will again be 5.94% only. This is how you can prove. Now in terms of amount, you can calculate that. You will have to make sure that you are converting that into 6 months because the rates are per annum. So this will be an inflow from the FRA seller, 1,40,000 euros. And this will be an outflow, actual outflow of interest to the bank for borrowing money. The total of these two will again be 1485. In any case, the total will be this much. Whatever extra you are paying, see, I will show you. Whatever extra you are paying here, the FRA will ensure that you are getting it back. Whatever lesser amount you are paying here than agreed, FRA will make sure that you are paying the balance amount to make sure that 5.94% is the cost to you. So in any case, this is how the hedging is done, that the rate is fixed. Okay. The purpose was not to calculate any kind of profit or loss. The purpose was to make sure that the interest is fixed. Interest cost to the company is fixed for that period. How 3 months future contract shall be useful for company if interest rate turns out as mentioned in part A above. If in reality interest rate turns out to be like this, now tell us that how the future contract will help us in hedging this. So have a look on this part now. We'll write few things about interest rate futures. First of all, interest rate futures are based on the prices of bonds and not on interest rates. This is the first thing that we should clear in our mind. The price of the interest rate future depends on the prices of the bonds and not the interest rate. So this is a general misconception that in the name itself interest rate is coming, and that's why the price of the interest rate depends upon the interest rate. No, interest rates futures price depends upon the bond. The asset under interest rate future is not interest rate, it's the bond's price. So second, asset under IRF is not interest rate, but it is the bond's price. Okay. Third thing, there is an inverse relationship between interest rate and bonds price. Understand, bonds price is the price of the interest rate future, and if an interest rate is inversely related to the bonds price, can I say that interest rate will also be inversely related to the price of the interest rate futures? Exactly. So we can replace this part with the interest rate futures, and that's where the entire magic will happen, because every time we are saying that interest rate is going up, or if we are scared of interest rate, or if we are scared of the rise in interest rate, that means the futures price is going to fall, and we have to take action not according to the rise in interest rate but according to the fall in the interest rate futures prices. Any asset which is expected to fall should be sold first and then bought back at the lower price to make sure we are profiting from it. So that's where, if the interest rates are rising, understand the logic. If the interest rates are going up, this is expected to go down, and that's why first sell, then buy. So what is going to happen? That is, interest rate is inversely related to bonds price, or we can write down interest rates is also inversely related to interest rate future. Next thing, fourth, standard theoretical price of interest rate futures. Price of IRF is equal to, understand, this is a standard method, 100 minus the ongoing interest rate. Simple, no technical formula in that. 100 is the bond's face value normally. Okay, since interest rate futures price is based on the bond's price, so 100 is taken as the base price for interest rate futures. Now whatever the interest rates are going on in the market, the opposite of that, 100 minus the interest rate, will be the price of the interest rate futures. So let's say, for example, 100 minus 5% is the interest rate. At that time, you can say that the price of the interest rate futures is 95. So 95, the price of the interest rate futures and the interest rate will sum up to 100. And that's what is given in this question. Understand? This is the price of the interest rate futures. Price of IRF, which is nothing but 100 minus 5.85%. 100 minus 5.85%. The total of both of them will be 100. And that's how it has been calculated. In this question, theoretical price is equal to the actual market price. In actual market, there will be some different price and it may not match. Like in actual market, the total of interest rate and the interest rate futures price won't match all the time. It is the theoretical that I am talking about. Theoretically, 100 minus interest rate should be the futures price. In this question, the actual market price is also matching with the formula. That means theoretical market price is equal to actual market price in this question. Okay. Now the fifth action. This is very important. Let's say this is interest rate. And this is the bonds price. Or we can say interest rate futures price. And this is the action that we are required. Time t is equal to 0, time t is equal to maturity. Okay. Based on this, you are going to solve the question, so please pay careful attention. If the interest rates are expected to rise, it means if the interest rate goes up, the bonds price will go down. Bonds price will fall or decrease in the future. So what are you going to do today? Today, sell interest rate futures and tomorrow means at maturity buy. So what will happen? It is expected to fall, right? So you can clearly see that you are selling at a higher price and buying it back at a lower price. So that's how you are making a profit. Now, if the interest rates are expected to fall, that means the bonds price will rise. And since it is going to rise, you can just draw it like this. What will happen? Obviously, we would want to buy at a lower price and sell at a higher price. So this is going to be your action. The action will always be same, sir. Buy when the price is low, sell when the price is high. So in both the cases, you are selling at when the price is high and buying when the price is low. So this is how you have to do the transaction. In this question, please understand, the risk of rising interest rates are to the borrowers. The borrowers are the people who are going to borrow money, and the risk to them is not the falling interest rate. It's the expectation of rising interest rates. So mostly you will see this will be the case of a borrowers. And this will be the case of investors. So if the party in the question is borrower, he will probably sell interest rate futures, because see how to interpret that. If the borrowers are scared of rising interest rate, that means the interest rate futures price will fall in the coming time or the future. And that's why we are going to sell it at a current price so that we can buy it back at a lower price after some time. So this profit will ensure the high amount of the extra interest that we are paying to the bank. The difference between these two will be the profit that will ensure the extra interest that we have paid to the bank. You will realize that if the interest rate will rise in this case, we will have to pay the difference between this rate and this rate, the extra loss. This will be covered up here. This will be covered up here. So this is how. If the person is investor, he is expecting that the interest rate might fall in the future, and that's a risk to him. So if the interest rates are going to fall, the interest rate futures will rise, because it depends upon the bonds price, and the bonds price is inversely related to the interest rate. If the bonds price is falling, bond interest rate futures will also fall. If the bonds price is rising, this will also rise. So the bonds price are about to rise, hence it's better to buy interest rate futures today and then sell it tomorrow. So borrowers, ultimately we are coming to a point that borrowers will sell interest rate futures and investors will buy interest rate futures at the beginning and do the opposite to settle the contract. That's what is going to happen. Okay, one more thing that you need to understand, 6. Even if it is not given in the question, standard lot size in IRF is 2000. In one contract, 2000 futures has to be traded. That's a standard in India for interest rate futures. I hope I have explained everything. The concept of how it is based on the bonds price, how it is inversely related, how it is calculated theoretically, when to buy and sell interest rate futures, and the standard lot size is 2000. Okay. So let me see if I can guide you a little more. Only if the website works properly. Let me check the, yeah, I think so. nscindia.com is the website and not nsc.com. I was not aware about it. Let me show you few things about interest rate futures. So you can clearly see that on the NSC website, we have the third tab of derivatives. So if I go into that third tab, you can clearly see that the first is the equity derivatives. We have seen that in the derivatives chapter. This is currency derivatives. We will look for this in the forex chapter. Commodity derivatives, rice, gold, and all that we have seen in the derivatives chapter. And this is interest rate derivatives. Interest rate derivatives means the interest rate futures, exchange traded. Okay. So if we come into this, this is how the interest rate futures are quoted in the market. The instrument is the government securities futures and the symbol is this. Everything works according to the symbol, and you should have this knowledge of reading this, how to read this. Let me explain you. 610GS2031. What does that mean? 6.10% is the coupon rate of this Government of India security. G means GOI, Government of India. S means security. And 2031 is the time when this security is maturing. This bond is maturing. 6.10% is the coupon on this bond, which is maturing in 2031. After that, expiry is 25th August 2022. So don't get confused. This expiry is of the bond and this expiry is of the interest rate futures that you are about to buy and sell. Okay. Option type, strike price, last transaction price 93, percentage change, volume 422 contracts, value, open interest. We have learned about the open interest as well. Okay, let me just explain few more things to you. If I go inside this, let's see what happens. Is there anything that I should explain? Okay. Let's go back to interest rate derivatives. 91-day treasury bill. So I'm going to this part, resources, learn, invest, list, trade, regulation, learn, market data, about. Yeah, I'm going into this about, and then I will go to this interest rate derivatives part, and I will see I can gain every knowledge, the entire knowledge of interest rate derivatives from this page. And let me go to the contract specification. In the contract specification, index futures, index options, futures, but we need it for interest rate derivatives. About interest rate derivatives. Yeah, and in that, just a second. Yeah, here you will find it. See, so on the government securities, this is FUTIRC. Understand, the instrument type is FUTIRC. FUT means futures, IR means interest rate, and C means contract. So future interest rate contract. The underlying asset is the government of India security. It's not the interest rate, it's the asset, the bond. And see, unit of trading, one lot is equal to 2 lakhs rupees of face value of government of India security, equivalent to 2000 units. So if you multiply 2000 with 100 rupees, the standard, it comes to 2 lakh rupees. So that's why the contract value is the quoted price, the given market price multiplied by 2000. This is one contract value. The tick size is 0.0025. Now let me explain this tick size. Let's say that the current price of the interest rate futures is 95.0025. Okay, so if it is going to change, the next change will happen only with a multiple of 0.0025. So if it is going to fall, it will be 95.0000, or it will be 95.0050. So it is going to fall by 25 points or increase by 25 points. Every increase and decrease will be in the multiple of 25.0025. It will never go to 95.0015. No, sir. This does not come under the tick size. So the next increase or decrease, what is that? Okay, just forget it for now. So the next increase and decrease will be 25 points up or down. So that's what the tick size is. The minimum change in the price. Monday to Friday, the market is open. It is open till 5 p.m. from 9 a.m. Unlike the equity market, which is just open for 3:30 p.m. On Monday to Friday. And yeah, that's it. There are many things to learn in this way. But yeah, this was only required for you for the purpose of our syllabus. I hope you have understood the interest rate futures. I will just summarize few things that you need to understand, because after that we are going to see lots of questions on this. Interest rate futures are based on the bonds price and not on the interest rate. So this is one thing to highlight. Second thing is the asset under interest rate futures is the bond price. So both of them are same. There is an inverse relationship of interest rate with interest rate futures. That means that if the interest rate futures are going up, interest rate will go down. Okay, the price of the interest rate future theoretically can be calculated with this formula. Actual market price may not be the theoretical market price. The action to be taken in the interest rate future for the purpose of hedging depends upon what we are expecting in the interest rate. So if we are the borrower, we will expect the market interest rate to rise. that will result into the fall in the futures price, and if the futures price is going to fall, we will sell it first and buy it later. So we are expecting this to increase and decrease, and we are taking an action in some other thing which is inversely related to the interest rate. Okay, and the standard lot size of the interest rate futures is 2000 bonds. One bond is equal to the normal face value of 100. Okay sir, let's go to the questions now. See, now let's go ahead with the interest rate futures. How we are going to hedge in this question? Just to summarize the question back to you, we needed 50 million euros. We wanted to borrow 50 million euros for 6 months after 3 months, right? And we are scared of the rise in interest rate for this. Now we have the 3 months 50,000 future contract available, the price of which is 94.15. Now understand one thing. We are worried about the rise in the interest rates. So this 5.85% is the current interest rate under this interest rate futures. The price is 94.15. So if we are expecting that this interest rate is going to go up, that means the price of the futures will go down. Hence, sell futures today. You will be selling the futures at 94.15 and buying it back after 3 months, because this is a 3 months futures, and buying it after 3 months. So the balance amount will be your profit. The difference will be your profit. But you need to learn one more thing in this question. Let me just go to our part. I think it was this. So we haven't drawn it yet. Drew. It's drew. Okay. So see, the borrowings required is 50 million. But this is required for the next 6 months. And that's why we are going to sell interest rate futures. You should know why we are selling. So let me just take it to this point. Borrowing means the rise in interest rate. Okay. I will just write down the steps. It means the rise in interest rate, which means the fall in interest rate futures, and that's why what we are doing is sell interest rate futures. And what exactly we are doing, how much position is required in the interest rate futures? There is a problem in taking the same position. So if we sell the interest rate futures worth 50 million, there will be a problem. I will tell you why. Because this 50 million will be borrowed by us after 3 months for a period of 6 months, and we are selling this interest rate futures only for 3 months. So there is a problem. I will explain that to you here. Understand, 3 months and 6 months. So this is a spot market and this is the futures market. Normally what happens is that every time we decide if we have a position in the spot market, how much should be the position in the futures market. In case of equity share, what we used to do in case of full hedging, we used to multiply the spot position with the entire beta to arrive at the futures position. But here, let's say we are going to borrow 100 rupees after 3 months, and we have taken a position of 100 rupees in the futures as well today, short position. So what is going to happen? If you will calculate 5% on this, it will be calculated for 6 months because the loan period is for 6 months, and the answer will be 2.5 rupees. So if this is a loss, it will be a 2.5 rupees of the loss. If this is a profit, will be a 2.5 rupees of the profit. But if you will calculate the same percentage here, it will only be calculated for 3 months. Why? Because the futures validity is only for the period of 3 months. Half of what the loan is. So 3 months on this will be 100 multiplied by 5% into 3 months will be 1.25. Now understand that you are not able to create a perfect hedging position. if this is a loss, 1.25 will be the profit, and still there will be a loss of 1.25. Or let me just write it straight away like this: 100 multiplied by 5% multiplied by 3 by 12. Am I right? Here the answer will be 1.25. So if there is a loss in the first case, there will be a profit in the second case, and still you will have a loss of 1.25. So will you say that this is a perfectly hedged situation? No, sir. So what went wrong? Why the answer is not 0? The answer is not 0 because the 100 that you are about to borrow was for 6 months, and the futures that you are taking is only for the 3 months. So what is the solution, sir? It's very simple. The loan period divided by the futures period. 6 divided by 3. 2 is kind of a beta. 2 is kind of a beta for the futures. You have to take double the position in the futures. You just do one thing. You double the position in the futures. Make it 200 instead of 100. That means in order to protect the borrowings of 100 rupees, you have to sell 200 rupees of the futures. So 200 into 5% will come to 10 rupees. 10 into 3 by 12 will come to 2.5. Automatically. And this will be 0. Understood? It's just because of the period, the difference in the period, the base, it's not matching. The spot position is for 6 months, the futures position is for 3 months only. So if the futures position is little shorter, like is less than the spot period, just increase the position, the amount of position in the futures, so that it is double. How to do that? The period of loan divided by the period of futures, 6 by 3, that will be 2. So twice is the required position in the futures for perfect hedging. 2 times is the required position for the futures for perfect hedging. In the same way, we are going to do it here. 50 million is the spot position for 6 months. We cannot take only 50 million for the futures position as well, because it is only for 3 months. That was for 6 months. Since it is only for 3 months, we have to double the position, 100 million. And that's what is done in the question. Have a look in this case. Number of contract that you have to borrow. Sell, in fact. Number of contract, 50 million. This is the position in the spot market, into 6 by 3. This is going to be your beta. This is going to be your beta, or we can say the position required in the futures market. So 50 million multiplied by 2 in the numerator, 100 million will be the answer that you have to take in the futures position. One contract consists of 50,000 euros. 100 million in the numerator, 50,000 in the denominator. The number of contract that you have to go short today comes to 2,000. That 2,000 has nothing to do with the 2,000 that we have learned in the concept of interest rate future. That 2,000 was interest rate future for one lot. Here there are 2,000 lots. Okay, so we have nothing to do with that 2,000. So 2,000 is the number of contract that you have to go short in order to make sure that complete hedging is being done. Now, everything will be same at the settlement. If the market rate goes to 4.5%, what is going to happen? You are going to take a loan of 4.5%. You are going to take a loan at 4.5%. You did the same thing in the spot market in the FRA case as well. See, interest rate after 6 months of on 50 million at actual rates will be 11.25, right? 11.25. This will be the same 11.25 and 16.25 in the futures as well. 11.25 and 16.25. No matter what you do in the derivatives market, the spot position will not change. The only thing that you are making sure is that whatever is the extra that you are paying in the spot market, that should be recovered from the FRA or interest rate futures or futures. If you are gaining something extra in the spot market, that will have to be paid back in the FRA or futures. So ultimately the cost will come to the same thing that you agreed in the very beginning. Now what will happen to the futures? Understand, this is the spot position. What will happen in the futures market? In the futures market, you sold the interest rate futures at time 0 at 94.15. Have a look. Do you agree? It was 94.15 at time 0. What you did is you sold those because you knew if the interest rate are going to go up, the futures price will fall, and that's why it's better to sell. So you sold at 94.15, one future. But what happened instead is, instead of rising, it has gone down instead of rising. So our expectation turned against us. So at the 3 months end, we are going to close the interest rate futures by buying it back. And at that time, 95.50 was the price. How did we calculate this 95.450? Sir, it's very simple. The theoretical price is 100 minus interest rate, and this is the interest rate at the expiry, 4.5%. Let me explain this to you with the timeline. You sold at 94.15 interest rate futures. Okay, when the ongoing interest rate was 5.85%. What does that mean? It means that you have fixed yourself with this interest rate. That means the total cost should not go above this. Instead of rising, the interest rate went down to 4.5%. So what will be the futures price today? 100 minus 4.5 is 95.50. You sold at this price, you are going to buy it back, and there will be a loss to you. The loss to you on every futures, 94.15 minus 95.50. So a loss of 1.35 on every future, on every 100 rupees of the position, or what we can say 94.15, a loss of 1.35, right? But this is all per annum calculation, 5.85 and all that. Now, do you understand this loss of 1.35? Apart from that also, you can also take a difference between 5.85 and 4.5. This will also come to 1.35%. This is in rupees, that is in percent. Whatever you want to take, it's the same, 1.35%. But understand, this was per annum. This was also per annum. So this will also be per annum. So the loss of per annum will be calculated on the position of 100 million. How are you going to calculate? It's very simple. 2000 contracts. Every contract had a value of 50,000 euros. That's nothing but 10 million. And on that, you will have to pay a loss of 1.35% per annum. But the futures maturity is only for 3 months. So you will only pay the loss for 3 months. Into 1.35% into 3 by 12. It comes to 337,500 euros. Am I right? 337,500 euros. 337,500 euros. Understand this logic. 50,000 was the size of one contract. You had taken 2,000 contracts. So that the total goes to 100 million. And how come the 100 million? It's very simple, sir. 50 million multiplied by 2. Twice the position in the futures. Why 2? Because of those 6 months and 3 months gap. So this is the logic. So there is a loss of 337 in the futures. That is a cash outflow. The interest will also have to be paid in the spot market to the bank for borrowing 50 million. 50 million at the spot rate for half a year. So that's 1125. The total of both of them will be 1462,500. Now what will happen in case of 6.5%? It's very simple, sir. We sold at 94.15. But if the market rate is 6.5%, the futures price is 100 minus 6.5. That is nothing but 93.5. And you can clearly see that. I will just start in a black color. We sold at this price and we are going to buy it back at this price. So 94 minus 93. 0.65% is the gain. This is a gain. You are buying it at a lower price. So gain 50,000 into 2,000, that is 10 million euros. 10 million euros multiplied by this percentage for 3 months is going to give you a gain of 1,62,500. But you are you have already borrowed from the market at the spot rate, 6.5% for half a year. So this is the cost. This is the total outflow. This is the inflow. Cash inflow, this is cash outflow, is coming to the same point, 1462,500. So if you do the calculation of this total outflow divided by the original amount of borrowing, and convert it back from 6 months to 12 months, it will give you 5.85%, which was fixed in the very beginning in interest rate futures. So in this way, interest rate future is helping you to make sure that the interest cost to you does not go beyond what you have agreed at the very first day of the start of this interest rate futures. So this is how you are going to show the transactions. Question number 13 is again on the same topic. This is going to be your homework. Please try it by yourself and you will get to know a lot of things. So this was same thing, sell to open, buy to close, loss and gain, then the interest, everything is same. I think interest rates are also same. Okay, question number 14 is going to be the next question. We'll take a break and I will be back with question number 14. See you. Okay, so I will look on question number 14 now. This is again an easy question. And one more thing to understand is that forward rate agreement did not include any kind of margin, but interest rate futures is exchange traded contract, and for sure the buyer and the sellers has to deposit a margin with the exchange to open the futures contract. Let's have a look on this question. A trader expects a long-term interest rate to rise. Most probably he is worried about the rising in interest rate, and most probably he is a borrower. So he is worried about the rise in interest rate. Now understand, if he expects the interest rates to rise, that means interest rate futures will fall. So the action that he is going to take is sell. He decides to sell interest rate futures, obviously, because the interest rate futures are going to fall in the coming time now. So it is going like this. At present it is at a higher price and it's better to sell it at this price rather than buying it, as he shall benefit from falling the future prices. The date of trade is 5th October and this is the trading date. Settlement price. Okay. Futures delivery date is 1st December 2019. Current future price is 93.50, at which you have taken a sell position. Futures yield is 7.36%. Now understand, theoretical futures price is 100 minus interest rate. So 100 minus 7.36 is 92.64. But it is 93.50 because it is actual futures price. So understand the difference. That formula is applicable for theoretical price, not the actual price. Actual price has a lots of other factors which no one knows. Futures yield is 7.36%. The lot size is 2000. Trader sells 250 contracts. So 250 into 2000 into 93.50 is the contract value. 250 into 2000 into 93.50 is the total value of sell position taken today. Of December 17, 10-year futures contract on National Stock Exchange on 5th October 2017 at 93.50. That's the price. Show daily mark to market transaction due to change in the future prices as below. You just have to make sure that every day's settlement is adjusted in the margin account. So from this particular price, if the price is falling by 1 rupees, there is a gain to you of 1 rupee into 2000 into 250. Right? So this 1 rupee is on one futures. Now there are 2000 futures in one contract and there are total 250 contracts sold by the trader. If it is increasing by 1 rupee, there will be a loss. Now understand, from 93.50 it is going to 93.6925. So it is increasing, right? There will be a loss to you. How much? 93.6925 minus the previous price, 93.50, right? Or we have sold it, so we can take it first. So write it like this, 93.50 minus 93.6925. You will see there is a loss of 0.1925 on every future, multiplied by 2000. This is a one contract loss, and multiplied by 250, that will be the total loss adjusted in the margin account. Next day, now what has happened is that your contract is settled at 93.6925. So next day you will be starting from this price. Forget about this price now. So 93.6925 minus 4625. That means there is a profit because the prices has gone down 93.6925, 93.4625. There will be a gain of 23 paisa on every futures multiplied by 2000 multiplied by 250, and in this manner you are going to do all the adjustments. See, initial margin is required, but the details are not given in this question. So don't take it, it's all okay. Just show the profit and loss in the margin account. See, loss profit multiplied by 2000 multiplied by 250. When you multiplied by 2000, you calculate the profit or loss for one contract, and these are for total contracts, total profit or loss. Understood? The only thing that you need to take care is that the first position is the sell, and then every day you are going to settle it. At the closing price will become a buy. Every day this price will become a buy price on the same settlement date, and for the next day the same will become a selling price. See, got it? All in all, you can cross check your calculation with 93.50, 93.1125, the difference between these two. This much will be adjusted in your margin account. This much will be adjusted in your margin account in total. Okay, sir. Let's come to the next question now. Question number 15. A bank has a large portfolio of Government of India securities worth 25 crore rupees. It has invested in the Government of India securities. Bank's portfolio consists of bonds with different coupons and different maturities. Okay. So lots of bonds have been purchased by the bank. In view of rising interest rate in the near term, the treasury head is concerned about the negative effect that this will have on the bank's portfolio. Why? I will tell you. If the interest rate will go up, the bond's market price will go down and the portfolio value will also go down. See, if you are expecting that the interest rate will go up, bond's price will go down, portfolio value will go down, and that's why we are worried about it, the falling prices. The treasury head wants to hold his entire portfolio and at the same time does not want to suffer losses on account of fall in the bond prices. So he does not want to sell the bonds and still does not want to suffer the losses for keeping the portfolio on hold. So what is the option? Hedging is the option. And with what? Derivatives in interest rate futures. What are you going to do in interest rate futures? Since you are expecting the bond prices to fall, interest rate future depends on the bond prices. That will also fall. It's better to take a sell position today in the interest rate futures and then buy position at the closing. Should the bank go short on the futures contract to establish the correct hedge? It should go short, not long. And the logic has to be written by you in exam that interest rates are inversely related to the bonds price. If the interest rate will go up, the bonds price will go down. Interest rate futures price is dependent on the bonds price. And since the bonds price is expected to fall, the interest rate futures will also fall. And hence we should get a profit from the falling prices. That's why it's better to short now. Okay, sir. And these are the dates given to you. Spot price today and 16th November 2017 due to increase in the interest rate. See, spot price of the Government of India security and the future prices are given to you. So this is your spot price and this is your futures price. Understand that you have purchased these bonds. So you have a long position in the bond and you will be taking a short position in the interest rate futures. Okay. Now after a particular period, what has happened? Spot prices of Government of India security and the futures prices, you will close it by short and long. And see, you have bought the bonds at 98.05. Right now they are at 97.25. So there is a loss of 0.8075 and profit of 0.6425. So to a maximum extent you have covered yourself in the futures, and still there is a loss of 0.165. Cannot help it. Let's go for it now. Since interest rates are expected to rise, interest rate futures are expected to fall, go for a short position. Okay, I think the value is also given, right? Let me just go. Oh, 25 crore. So they have given us the values as well. Okay, see. So in the cash market you have purchased bond, that means you have a long position at this price of 98.0575. The total portfolio value is 25 crore rupees. So when you divide the total portfolio with the current price, you will get on an average the number of bonds, which is 25,49,525. However, this is not required as such, but okay, we can do the calculation of total profit and loss with these figures. Right. So this will be required. In the futures also we can do some transactions like this. Have a look. The period is same, so we can cover how much position to cover in the futures. That's the main question, and I think we should cover 25 crore itself in the futures. How to go with that? See, interest rate futures we have to go short, and this is the current market price. And now the question is, how come we have calculated the value? The value has been calculated based on the number of lots. This is a standard practice, need not be given in the question. It is not given in the question as well. So you have to remember that one lot consists of 2000 futures, and one future is currently priced at 93.7925. So you already know the price of one futures. The only thing that you need to know now is how much should be the total position in the futures. So you can clearly see the total position in the futures is equal to the position of the portfolio. This is beta, the risk to be reduced, multiplied by, I will just make sure this is corrected. Instead of minus, it is multiplied by, divided by the one contract value. It is the same formula of the derivatives. Number of contract is equal to the portfolio value that you want to hedge multiplied by the risk you want to reduce. You want to reduce the entire risk multiplied with 1. Multiplied with the entire risk. In this question, nothing is given related to the beta, that's why 1, and divided by one contract value. So when you do this type of calculation, it becomes very clear for you to understand that how many contracts you have to go short on. Do you understand this procedure? This is the portfolio that you are carrying in the cash market and you want to hedge it. This is the price of one futures, and this is the total lot size. The total denominator gives you one contract in the interest rate futures. This much should be the value of the contract. So total value divided by one contract's value will give you the total number of contracts that you have to enter into. Obviously you cannot enter into a fractional contracts, that's why you are little over hedging. 1333, you are going about 25 crore. So that you can clearly see in this case as well, we have hedged for 25 crore 50,000, a little over 25 crore rupees. So very clear, let's be very clear. We have a long position in the 25 crore rupees of the bonds, and we have a short position in 25 crore 50,000 of futures. How did we decide that? It's very simple, sir, with the number of lot. And it came into fraction, that's why it is 50,805 extra. Otherwise it would have been the same 25 crore. Okay. Then what happened? Nothing, sir. We just have to close the position at these prices. The number of bond multiplied by this, or the number of bond multiplied by this, will be the total loss, and the number of contract multiplied by this multiplied by 2000 will be the total profit in the futures. Have a look. Let's first calculate. Okay, they have done it like this. I would suggest instead first calculate the profit or loss on one bond and one future, and then multiply. Simple, keep it simple. One bond, one future, and then multiply this loss with number of bonds, and multiply this with the number of futures. How many number of futures are there? 1333 into 2000. This much futures are there that you have taken a short position on. If you want me to write down, I will just do it like this. On settlement, this is question number 15. See, short cash futures. So we had a long position, we will take a short position. We had a short position, we will take a long position. In this market there is a loss, in this market there is a gain. We will multiply the loss with number of bonds. We will multiply the gain with number of futures. Very simple. Okay. And this is going to be total of the loss and gain. Okay. So write down the prices. 98.0575. 93.7925. Okay, sorry, 97.2500, and in this 93.7925, 93.1500, 0.8075. Let me just calculate it once again. And a gain of 0.6425. Okay. Number of bonds. How many bonds did we buy? In the very beginning it was 25. The number of bonds that we had is 25 crore 49, sorry, 25,49,525. And it's very easy to understand, sir. This was the number of bonds at the beginning at this price. So if we have a loss on one bond for this much, how much will be the loss on these many number of bonds? Very simple. 25, 49, 525. The loss will be 20, 58, 741. Okay, let's talk about this. How to calculate the number of futures? It's 1333 multiplied by 2000. So that's around 26,60,000 futures in 1,333 contract. So the total profit is 17,12,905. We can do the net here, that we have a loss of 20,58,741. So the total loss is 345,836. Now you can see that we have hedged. Although this situation will not be called as a perfect hedging, and there is a reason for that, but still by using the futures we have reduced the loss from 20,58,000 to 3,45,000, and that's a big difference to consider. For 17 lakh rupees of the loss has been saved just because of using the futures. Why this figure is not coming to zero is because of this, that the relation between the spot changes and the futures changes was not known to us. And the beta that we have taken here, the risk that we have taken here is just one, which came out of nowhere because of the unknown relation between the spot and the futures prices. If we would have known the relation, let's say the relation is 1.2, 1.5 or something like this, then we would have easily calculated the hedging position for zero loss. But that's okay. We have still reduced the loss to a greater extent. See, the loss is 345,789 or something, 345,836. That's the rounding of difference. Okay, understood the concept. You might say that the net gain or loss should have been zero if we are hedging. That's what I have written there. Practically this is not possible because of the two reasons in this question. Okay. Why? The change in the bonds price is not equal to the change in the interest rate futures price. You can clearly see that both the bonds and the interest rate futures have gone down, have fallen, but the percentage change in the bond prices was 0.8235 and the percentage changes in the futures prices was 0.6850. So the loss is more than the gain. and that's why we are having a net loss. Second, contracts are not allowed to be traded in faction. You remember that point something of the contract, resulting into over and under hedging. So these are the two reasons in this question. Major reason is this, that the percentage change in the bond price is not equal to the percentage change in the interest rate futures. Although even if they would have given the relation between the bond and the interest rate futures, that means the beta, then it would have been quite possible to find out the exact position where we can have a complete hedging. But that's all fine. Hedging itself does not mean complete hedging. Hedging means reducing the maximum possible loss. That's what we did. We have reduced the loss by 17 lakh rupees, and that's what people do in big businesses. They actually do it. This is a real thing. This is not just something came out of somewhere. No, this is a real thing. Okay, sir. So this was question number 15. Let's start with question number 16. This is going to be an interesting part once again. Now look at this question. Question number 16. This is an easy question. The moment you will read it first, it will look like it's little difficult to solve, but it's pretty easy, man. Atul wants to take home loan. Wants to take. He has not taken yet. So in some time, in couple of months or 3 months, he is going to take the loan from the bank. So if he is taking the loan, that means he is the borrower, and the risk to him is that the interest rate will rise. If the interest rate will rise, the interest rate futures will fall, and it's better to sell at a higher price and buy it at a lower price if you want to do the hedging. So the position that is required to be taken in the interest rate futures is short. This is how you have to interpret. Home loan is the asset, or we can say the criteria in this question. So we are going to take money, or we are going to borrow money. Borrower has the risk of rise in the interest rate. If the interest rates are going to rise, the interest rate futures will fall, and the falling interest rate futures will give you a profit only when you take a short position today. On a floating interest rates and needs to hedge his interest rate risk. If bank increases the floating rate, what will happen? If the bank increases the floating rate, it will affect the cash outflow of Atul due to increase in monthly EMI. Obviously, the monthly EMI will increase if the interest rate by the bank increases. Therefore, to manage his interest rate risk, he may enter into interest rate futures contract. Interest rate futures contract. Okay. And please write down, he is going to short. To manage the risk, that means hedging. What is the risk? That the increase in monthly EMI will result into loss. The bank is charging floating interest rate of BPLR. BPLR. Benchmark Prime Lending Rate. It's just another lending rate like LIBOR, MIBOR. So this is a floating rate which keeps on changing. Whatever will be the BPLR in the market at every point, plus 2% will be charged by the bank. So which is currently at 5%. You can clearly say that the BPLR is currently at 5%. So 5 plus 2, 7% is my home loan rate today if I take the loan. The loan details are as follows, that I am going to take 50 lakhs rupees of loan. I am about to take, I want to take, right? Rate of interest is 7% as calculated by us like this, 5 plus 2, that is BPLR plus 2%. Tenure is 10 years. EMI right now is 58,054. Don't try to calculate the EMI. Future details on 31st January 2018. See, today on 31st January 2018, the details are given to us that we have to pay the margin. If you want to enter into a futures contract, the margin will be 2.5% of the value of futures, and the value of futures will be exactly equal to the loan amount. So 50 lakh multiplied by 2.5%, that is what we have to pay today, 1,25,000 as a margin. This will be a deposit only. Price is 100 rupees. This is the interest rate futures price at which we are going to go short. Interest rate is 5%. So theoretically we can say that interest rate minus 5 is 95. So instead of 95, the price of the futures is 100. Okay, that's the theoretical price. This is theoretical. Futures price on 2nd April 2018. This is on 31st January 2018 and this is on 2nd April 2018. Why 2nd April? We will assume that this is going to be a date where we are going to take the loan. So January, then February, March and April. Okay, let me draw it. If I think we have a space here. So this is 31st Jan. Okay, this is going to be 28th Feb, 31st March, and this is going to be 2nd April. So take this question in such a manner that we have to take a loan on 2nd of the April. Today we are standing at this point and we will be borrowing from the market. How much? 50 lakh rupees. So we need to take a home loan of 50 lakh rupees after almost 2 months. Right now the interest rate is coming to 7% on that, and accordingly we have calculated the EMI of 58,054. We have to pay this much of the EMI, 158,054 multiplied by 120. Right, 120 EMIs has to be paid. Now, but we are worried that by the time we actually take the loan, this is just today's rate. By the time we actually take the loan, the rate in the market might go up. Which rate? The BPLR, which is 5% right now. If this 5% goes to 6%, what will happen? 6 plus 2, 8% will be our interest rate, and accordingly using 8% rate, the EMI will be again calculated, which will obviously increase. If the rate increase in the rate of interest will increase the EMI. Okay, that's the risk, and because of that we are going short today. So what are we going to do? It's very simple, sir. In order to hedge this, we are going to enter into interest rate futures. We will go short on the futures here when the market price is 100 rupees. Okay. How many contracts you are going to buy? It's very simple, sir. Number of contracts is calculated in the same manner we did it in the derivatives chapter. 50 lakh is the total amount of spot position that we want to hedge. There is no beta given in the question to multiply with this, so keep this position equal in the interest rate futures. So this is the total position required in the interest rate futures as well. Okay, then 50 lakhs divided by one contract consists of 2000 by default, even if it is not given in the question. By default 2000 futures multiplied by the futures price, which is 100 as of now. So the number of contract that is required is 125, I suppose. 50 lakhs divided by 2 lakhs. Sorry, 25 only. So you have to go short on 25 contracts. So this is what you are going to do. Short on 25 contracts today. And this will expire. This will expire after 2 months. So you will go long on all the 25 contracts at that day's price. Now understand, the price on the 2nd April 2018 for futures went to 93.21, and you can clearly see that there is a benefit. You have sold the futures at 100 and the price is now 93.21. Why the price has gone down? Because the interest rate has gone up, and that's why the price has gone down for the interest rate futures. Right, okay. In case there is a 100 basis point increase, 100 basis point means 1% increase in BPLR, which is 5% right now. If it increases to 1, it becomes 6%. It shall lead to change in the floating rate from 5 to 6%. Do you agree with this? Which will impact the EMI. The rate of interest will be BPLR plus 2%. BPLR now is 6 plus 2 is 8%, and you can clearly see there is an increase in the EMI. Earlier it was 58,054, now it is 6663. So before 2 months, when I was saying that I'm going to take loan after 2 months, the EMI that I calculated was 58,054. That was about to start after 2 months. But when actually I borrowed money after 2 months, the actual EMI came out to be 6663. So there is a loss to me because of the increase in EMI. How much is the loss, sir? In the spot market, you have lost 6663 minus 58,054. So if you do the calculation, so that's around 2,609 rupees extra every month you are going to pay on 120 EMIs, forgetting the present value. It comes to a loss of 313,080. So that's a total loss as expected by you. that if the interest rate is going to go up, the loss will be there, and that's the loss of 313 lakh 80 rupees in total, ignoring the present value, because the EMI will be paid over 120 months. Okay, sir. What has happened to the futures then? There is a profit in the future. How much? 100 minus 93.21. That's 6 rupees 79 paisa on every futures. We have 2000 futures in every contract, and in total 25 contracts. So what are you going to do? 6 rupees 79 paisa into 2000 into 25. So there is a profit of 3 lakhs 39,500. So you can clearly see from here that because of the futures you have a profit of 339, and in the spot market you have a loss of 313. One more thing is there. What happened to the initial margin, sir? There is something called as initial margin given in the question. So in order to open a position in the futures market, we have to pay the initial margin of 1,25,000 rupees. And that 1,25,000 rupees will be borrowed by us for the next 2 months. Let's have a look on the calculations now. We have just completed the question. So this is at time t0 and this is at expiry. So let's first find out what has happened at time t0. And you can clearly see we are going short on interest rate futures. 100 rupees is the current future price. 2000 is the lot size by default, even if it is not given in the question. So the denominator represents the value of one future contract. The total value required in the future contract is 50 lakh because of the same position in the spot market. So there are 25 contracts that we are going to go short on. Now we are going to pay the margin. Margin on 50 lakhs multiplied by 2.5%. Because the same position we have taken in the futures. Basically margin is calculated on the futures position multiplied by margin ka percentage, right? In this question, the spot position is equal to the futures position, but it will not be there in all the questions. So never make a thumb rule that, okay, we have to borrow 50 lakhs. That's why margin is 50 lakhs into 2.5%. No, we have to borrow 50 lakhs. The same is the position in the futures, and the margin is nothing but the futures position into percentage. Sometimes in some other question, there might be a beta given to you, or they will say that only hedge to the extent of 50%. Then even if 50 lakh is given in the spot market, what are you going to do in the futures market? 50 lakhs multiplied by 50%, that means 25 lakhs, because you are doing only 50% hedging, not a complete hedging. So 50 lakhs multiplied by 50%, that is 25 lakhs multiplied by 2.5% will be the margin. Margin, understand the concept of margin. You are paying margin because you want to start a futures position. So what is the value of the futures position? What's matter for calculating the margin. That will be 1,25,000. How are you going to pay them? You are going to borrow for the next 2 months. That 1,25,000. Make sure that you are paying interest on that after 2 months, right? So on April 2018, the interest rate increases. There is a loss in the cash market due to increase in the EMI. What is the loss? Sir, the difference in the EMI multiplied by the total EMI. We are just starting the EMI, and it has increased. So the total extra EMI that we have to pay is 313,080. Obviously, you may have a debate here in terms of time value of money, but forget that. Profit in interest rate futures, 100 minus, you had a short position here, you will take a long position. This is on one future. Total 2000 futures in one contract, total 25 contract. So the profit is this much. Now, last but not the least, interest on borrowing. Sir, interest on borrowing at what rate? At the current rate, 1,25,000 into 8% into 2 by 12. You can just have a debate on this one as well. You can say that I will have to pay interest on at 7%. So you can take 7% as well, because this is not a exam related question. So there is some ambiguities in the details given in the question. You can take the 7% as well here, if you might have borrowed it at 7%, the previous rate. So ultimately the net gain or loss will be this. You might also again ask a question that what happened to the 1,25,000? It's very simple, sir. 1,25,000 at the expiry will be paid back by the exchange. That was a deposit with the exchange, right? So it will be given back to us and we will give it back as a principal repayment along with this interest. So 1,25,000 is coming in and going out as well. So there is no need to take it here because that's a cash inflow and outflow at the same time. Okay. This way we have reduced the risk of a loss. and in fact there is a profit to some extent, 24,573. However, that was not the purpose. The purpose was to hedge. This is how we have to solve the question, sir. That is what all about the interest rate futures. This is question number 17. Let's have a look. And now when I'm going through this concept, this question number 17, I realize that this is a question related to swapping. Okay. And what we are going to do is we are going to postpone this question for the end of the chapter. Let's first move on to the question number 18. And now this question number 18 is related to two different concepts called as CTD and CF. What is CTD? It's called as cheapest to deliver bond, and CF is the conversion factor. So in the coming 3 to 4 questions, these two concepts are very important in the interest rate futures. It's a part of the futures itself, but this is something that you need to learn. So first of all, let's complete the concept. It's an interesting one, so please focus on this. So let's start with the interest rate futures. What happens is that in interest rate, there are two things that we are going to do. Either we will be borrowing money or depositing, that means investing money, right? So if we are borrowing, the risk is that the interest rate will rise. Am I right? And if you are investing, the risk is that the interest rate will fall. And for that purpose, you seek hedging. Am I right? Okay. If the interest rate are expected to rise, interest rate futures are expected to fall. Am I right? And if the interest rates are expected to fall in case of investment, the interest rate futures are expected to rise. The interest rate future is based on the bonds price. It is based on the bonds price. Now what you will do with the interest rate future in terms of hedging, you will go short on interest rate futures. You will go short on interest rate futures. Okay. I think I will just change the format. Just give me a second. So if interest rates are expected to rise, in case of borrowing, interest rate futures will fall. And in case of investment, if you are expecting that the interest rate will fall, interest rate futures will rise. One more thing that you are aware about is interest rate futures are based on the bonds price, right? So in order to do the hedging, what are you going to do in this situation? You are going to go short IRF. In this case, you are going to go long IRF. Why short? I will just tell you. You are clearly expecting that the interest rate futures prices will fall. See, fall. So draw a line which is going down, and you tell me, you are standing at the beginning, whether you would like to buy at this higher price or sell. Obviously sell, because I can see that tomorrow the price is going down and I don't want to sell at the lower price. And in this case, the interest rate futures price is expected to go up. And obviously what I'm supposed to do at the beginning, I will go long, I will buy at a lower price and I will prefer to sell at a higher price, right? In case of interest rate, we are expecting a rise. We are expecting it to rise. We are expecting this to fall. So it has a meaning. It's just not it's not just a line. Okay. This is what we have learned till now. But when it comes to short futures, what happens at the expiry? This is what you start at time 0. Okay. But what happens at the expiry of the interest rate futures? There are two things that will happen. We have learned only about the cash settlement till now. We have learned about the cash settlement. In this case also, there are two possibilities. In India, mostly it's a cash settlement. Cash settlement. How are you going to settle the short IRF? Obviously, you are going to go long on IRF and it will be settled. Here you will go short on IRF. Why? It's simple, sir. If you have a long position in the interest rate future, take the opposite position and settle the difference. There will be some profit or loss. In this case also there will be some profit or loss. So there will be some gain or loss. That's the end of the... In this case also there will be some gain or loss. So how does this helps in hedging? It's very simple. I will tell you. If you are supposed to pay higher interest rate, there will be a loss and futures will give you a gain. In that case, this gain will make sure that the cost or the loss in increase of interest rate due to increase of interest rate is getting compensated. In case your expectation does not come true, what will happen? Interest rate will fall if the interest rate goes against your expectation, and you will have a profit in this case, but you will suffer some losses in this case. So again, this profit will get compensated with the loss. So we are framing a transaction in such a manner that if one market gives us the loss, that loss is compensated by the profit in the other market. In case we are gaining some amount in this case, in spot market, there will be a loss in the other market. So it will again be compensated and the net will be zero, because our purpose is not to earn, our purpose is to hedge. There are some people who will directly take the position from this point. They don't have to do anything with the borrowing or the interest rate rise and everything. They don't have to do anything with this thing. Okay. So they will start directly with the derivatives and they will end it here. So there will be a gain or loss to them. And that's called the speculation. Okay, if you have the borrowing and then you are doing the short future position, it's hedging. If you're directly doing the short future position without any purpose, that's speculation. Okay, so this is what you learned till now. But there is one more thing which is possible. It's called as physical delivery. It's called as physical delivery. Now please focus. Entering into a transaction in short interest rate future, that means selling futures. Selling future means you are agreeing to sell the bond. Because IRF is nothing but the bond's price. If you are selling interest rate future and it comes under the physical delivery, that means you are supposed to sell the bond at expiry. Okay. On this date, you are supposed to sell the bond. What will happen in this case? When you enter into a transaction of long IRF, that means you are buying the bond. That means you are making a promise to buy the bond at expiry. So you are entering into a transaction to buy the bond at future. So you will have to buy the bond, and that's a physical delivery. Okay, that has to be a physical delivery. Now what happens is that in physical delivery, you cannot, because this interest rate futures contract is exchange traded contract. There are some set of bonds only which can be sold in the market in case of physical delivery. So there is a list of the bonds which you can choose from which bond you have to exactly sell. Now what will happen at the maturity, that if you have promised to sell the bond at the beginning, you will have to deliver the bond. And in the other case, you will have to buy the bond. For the time being, I'm skipping this entire position and we will focus on this position, because this will be the maximum number of time this will be the question to you, situation to you. That means you will be the borrower maximum number of time. In the previous parts also, you can see that the question was mostly focusing on the borrowing, not on the investment. Now we have to deliver the bond at the expiry. Which bond you are going to sell? First of all, you don't have the bond at this 0 point. You should have bought it now in the very beginning, but you didn't do that. You don't have any bond to sell on this particular date. Also, this interest rate future contract is exchange traded, so everything is standardized and described by the exchange, even the list of the bonds to be delivered. So you don't have a choice to deliver any kind of a bond, but to choose from the list of the bond. So you will have a list of the bond. See, let's see, I will just write it here. So there will be some list of the bond A, B, C, D or E. Let's say for example 5 bonds are there. You can choose to deliver any kind of a bond that you want on this particular date expiry. Let's say that for example when you took the short position, the interest rate futures was priced at 100, to be very simple with the question. So what has happened is that at the very beginning you have fixed the selling price. That means 100 is what you are going to receive. In order to deliver the bond, you will have to buy the bond at expiry, isn't it? You will have to first buy it, and the selling price was already decided by you. So what are you going to do? Just find out the current market price. Let's say the market price is 90, 92, 105, 101 and 97. So tell me which bond you are going to buy in order to deliver it here at 100 rupees. You will have to buy the bond because you didn't buy it at the beginning. Okay, you will be buying the bond at expiry in order to sell the bond under this contract at 100 rupees. Every person will get an idea that it's better to buy bond A because it is cheaper. Buying it at 90 rupees and selling it at 100 rupees is the best that you can do. And every seller or every party will start doing it. In this manner, you will always have a profit. You will always have a profit. But what will happen? This is the interest rate futures contract where two parties are entering into a contract. The other party who bought the interest rate futures from you because you sold it, the other person bought it. He will never have a profit. In such a manner, if this transaction is going to happen, you will choose the lowest possible bond and then deliver it at 100 rupees, which was fixed. In this manner, the transaction will never happen because the other party will never get a chance to make a profit. And if he knows that he is not going to make a profit, then why he is going to enter into a transaction with you on this date? Got it? So what will happen? What is going to be the procedure? I will tell you. The list of the bond was known to you at the very beginning itself. Okay. It will be known to you at this point itself. This point. Let me just write it. So what will happen at the time of entering into a futures contract? You will know the list of the bonds that you will be able to deliver. Out of this, you can deliver any bond. And along with the bond's name, there will be some other number given for every bond. And it will be like this: 1.05, 0.98, 0.93, 1.20, 1.50. So what are these numbers? These numbers are called as conversion factor. These numbers are called as conversion factor. It means that at the time of entering into a short futures position, you will be given with this list that out of these bonds, you can deliver any bond at the expiry. Every bond's a base price is fixed at 100 rupees. But A, B, C, D, E are the bonds which you can deliver. Out of this, you can deliver any bond, and the conversion factor of these bonds are given here. It means that if you choose to sell, if you choose to sell bond A at expiry, the amount that you will receive is the futures position, the price at which you agreed multiplied by the conversion factor. So 100 multiplied by 1.05 will be your selling price. 100 multiplied by 0.98 will be your selling price. 100 multiplied by 0.93 will be your selling price. This is how it is going to work. Now understand what will happen. Okay, first of all, these convergence factor will be decided by the exchange itself, depending upon the risk, the history, and lots of other factors. Okay. Now what will happen at expiry? If you choose to deliver A, you will be buying it at 90 for sure. You will buy it at 90, but you will get 100 into 1.05. So the amount that you are going to receive is 105. Okay. I will just do one thing. I will write down the selling price on this side. This is going to be the buying price. And the selling price will be written here. And what is the formula for selling price? The price of interest rate futures that you have fixed in the beginning multiplied by the conversion factor. Simple. Now understand. 100 multiplied by 1.05 is 105. 100 multiplied by 98 is 0.98 is 98. 93 is 93. 100 multiplied by 1.20 is 120 and 150. So according to these factors, the selling price of delivering each bond is given here. Okay. Now you decide which bond you want to buy at expiry so that you can deliver here. Which bond you want to deliver. Now it's very difficult, sir, to decide based on these numbers. I cannot simply say 90 is the cheapest to deliver bond. Cheapest will not be decided now on the basis of the buying price or on the basis of the selling price. It will be decided based on the profit or loss. So what are you going to do at expiry? You are going to analyze every situation. If you deliver bond A, you will have to buy it at 90 rupees, the market price, and you can sell it at 105. The profit in this case will be 15 rupees. The profit in this case will be 6 rupees. The profit in this case will be 12 rupees. The profit in this case is 19 rupees. The profit in this case is 53 rupees. Now you tell me, even though 97 is not the cheapest if you look at just this number, but you can clearly see that the cheapest to deliver the bond for you is this bond because it is giving you the maximum profit. So this will become my CTD bond, cheapest to deliver bond. Now you understood the concept of cheapest to deliver. Cheapest to deliver is not the bond with the lowest price or buying price or highest selling price. No, sir. It's not the bond with the lowest buying price or highest selling price. It is a bond which gives the maximum profit or the minimum loss. See, in this situation, all the bonds are giving me a profit. There might be a situation in the exam that all the bonds are giving losses, and still, because you made a promise, you have to deliver it, even though every bond is giving a loss. So in that case, what are you going to do? You will find the bond with the lowest possible loss. The loss will be there, but you will try to make sure that the loss is minimum. So maximum profit and minimum loss is the condition for CTD bond. So how are you going to decide which bond is CTD? It's very simple, sir. Which gives you maximum profit or minimum loss. This will be applicable only in case all the bonds are giving you the loss. At that time there will not be any bond which is giving you profit. Then you will choose the bond with a minimum loss. Do you understand the two concepts in this entire situation? I will just sum it up. In case of interest rate, either there will be a borrowing situation or investment situation. If the situation is borrowing, which will be 99% of the time in the exam, the risk will be of interest rate will rise. If the interest rate rises, you will have to pay more interest on the borrowings. And since interest rate is going to rise, it is inversely related to the interest rate futures, which is expected to fall because of the inverse relationship. Now, if the interest rate or futures are expected to fall, it's better to short interest rate futures. So the price will be decided today itself. And in case of cash settlement, you are just going to go long on the interest rate futures of that date, the price of the IRF at expiry, and you will have some gain or loss. That's very easy. We have seen some questions on that also. But in case of a physical delivery, you will have to actually deliver the bond, because you promised to sell the bond, sell IRF, sell bond. So you will have to deliver the bond at that case, and there will be a list of the bonds that you want to choose from the list. So A, B, C, D, E are the bonds that you knew that these are going to be the bonds out of which I will have to choose one, and the factors were also known at the very first day. You will have to decide that which bond you would want to sell. Whatever bond you would choose, you will get that conversion factor multiplied by the price decided as a selling price. Okay, this is going to happen. So at expiry, you will buy the bond at the ongoing market price of the expiry, and you will sell it at this price, which is arrived after multiplying the interest rate futures price decided by you at the very beginning, multiplied by the conversion factor. Now what will happen in case the buy bond situation is there? Okay, I will show you. If the situation is buy bond, that means at expiry you will have to buy the bond. What are you going to do by buying the bond? You will have to sell it in the market, and the market price will be this 90, 92, 105, 101 and 97. Now this will become your selling price. Okay, just understand. Suppose I keep the conversion factors. Let's take an example that I'm keeping the conversion factors and the market price of those bonds same. Okay, now what will be the situation? In case of long, you will get the selling price here minus buying price. See, let's say the buying price that you decided at the very beginning is also 100. Long IRF, that means you have decided to buy the bond at expiry at 100 rupees. If you are going long on IRF, you have decided to buy the bond at 100 rupees. And whichever bond you would want to buy, these are the conversion factors. Now the buying rate will be multiplied by the factors. In this case, the selling rate was multiplied by the factor. Now the selling price is fixed. What will be the selling price? A, B, C, D, E. The selling price is the price at that date itself, that is 90. I'm keeping the prices equal, 92, 105, 101 and 97. This will become your selling price, and the buying price will be exactly opposite, minus 105 if you want to buy bond A, minus 98, 93, 120, 150. So in any bond you can choose to deliver on that date. You will have to buy it and then sell it in the market. If you want to buy it, IRF multiplied by the conversion factor will be the formula. IRF multiplied by conversion factor will be the formula. The formula remains same, but it is now shifted to a buy position because you have promised to buy the bond at 0th time. Okay. So what is the profit or loss in this case? You can clearly see that all the bonds are resulting into losses, and there is a loss of 15 rupees, 6 rupees, 12 rupees, 19 rupees and 53 rupees. Which bond is the CTD bond? Which bond is the CTD bond? Sir, this bond is the CTD bond. I know that every bond is giving me a loss. I will choose the bond which gives me minimum loss, that is bond B. So in case of sell position with the same figures, bond E is the cheapest to deliver. In case of buy position with the same figures and bonds, bond B is the cheapest to deliver bond. Understand, the logic is simple. Cheapest to deliver bond is the bond which is giving you the maximum profit or the minimum loss. Okay. One thing that you need to notice is that if you have a short future position, then the selling price is decided by 100 multiplied by factor. If you have a buy position, long position in the interest rate future, then the buying price is multiplied by the conversion factor, and the price on that date becomes the opposite price. That's it. So this is how we have to solve some questions for the cheapest to deliver bond. I think 3 to 4 questions are there. Along with that, arbitrage, if there is anything possible in the arbitrage. So let's have a look on the questions. Okay, so this is going to be question number 18 now. Have a look. On 15th October 2017, This is a question I think from the study material, so there might be some problem in the framing of the question, so please ignore that. Okay, so on 15th October 2017, 6.35% Government of India 2020, I think, at the current market price of 97.2550. Okay, you buy 6.35% means you have a long position on the bond in the spot market at a price of 97.2550. The simple meaning of that statement is you have purchased a bond today in real in the spot market at 97.2550, and the conversion factor is 0.9815, which will be related to futures contract and not the spot contract. December 2017 future. So right now 15th October 2017 is going on, and from that date till December 2017, so I can clearly say that 15 days of October, 16 days of October because of 31st October, 16 days of October, 30 days of November, and 31 days of December comes to 46, 31, 677, I think. Right. So after 77 days, futures is going to expire. So December 17 futures price is 100 rupees, 7% yield. The borrowing cost is 4.25% if you want to borrow any money. Explain the arbitrage opportunity, and it's very simple. Understand the situation and you will have the question. So this is 15th October, this is 31st December. Okay, and there are 77 days in between this. This is a spot market. You have purchased a bond worth 97.2550, and the futures are also available, which is expiring on 31st December. The price of that is 100 rupees. Okay, now this is the real bond. Now understand that if you sell futures today and then you decide to deliver the bond, since you have promised to sell the bond in this futures, you decide to sell the bond, you have the bond in the market. This is the only bond. Not the list of the bond is not given in this question, the single bond is given, and this bond's conversion factor is also given to you. Okay, so the conversion factor is 0.9815 for this bond. For this bond, the conversion factor is 0.9815. Okay, that means if you will sell this futures and deliver this bond, you will get 100 into 0.9815, that is 98.15 rupees. That's the actual price of the futures, not 100 in real sense. This is the actual amount that you will get at expiry if you sell the futures. Okay, so question is asking you about the arbitrage opportunity. Arbitrage opportunity can be explored only if the actual futures price does not matches with the theoretical futures price. So we have to calculate the theoretical futures price. So how to calculate the theoretical futures price? It's very simple, that this is the only bond available in this entire question. What you can do is you can calculate the bond's price or the cost on this date. So what if you buy the bond today, borrow money, buy the bond? That means you are not investing your own money. The purpose, if you remember from the derivatives chapter, is to own the bond at this date. So what will be the cost of that? It's very simple, sir. Borrow money, buy the bond, and keep the bond for this 77 days. And after 77 days, you will have the bond with you, and repayment has to be done. So that will be the cost of the bond after 77 days. This plus the interest for 77 days. So if we do the same, 1 plus R, simple formula. So it will be 97.2550 in bracket 1 plus 0.045. You can clearly see that 4.25% is 0.0425. Per annum rate 77 divided by 365. We will have the theoretical cost of the bond that's 98.127. Okay, 1270. This is the theoretical price, and you can clearly see that the actual futures price is not 100 but 0.9815 is the conversion factor, right? So in reality you are going to get 98.15 if you sell it. If you buy it, you will have to pay this much. Now you decide. Don't you think the actual futures price quoted in the market today is higher than the theoretical price? And if it is higher, that means it's better to sell the futures. And if you are selling the futures, it's better to buy the bond in the spot market. So have a look. Futures are overvalued, and the overvalued item should be sold. Sell futures, that means buy bond in spot market, and in order to buy the bond, you will have to borrow money. Now this is how the arbitrage transaction will happen. The very first step, the decision is taken in this manner, but the actions will be taken in this manner. So you will borrow money. How much? 97.2550. Why did you borrow this money? To buy the bond. So do it. Buy the bond 97.2550 and then sell IRF. When you sell it, there is no cash outflow except for the initial margin, which is not given in the question, 0. And after 77 days, settle everything. Repayment. You will repay the bond, repay the borrowings. The repayment will come to this much of the amount, 98.1270. That's the interest rate, right? So 98.1270 and sell the bond. What will be the price of selling the bond? Obviously, see, understand, if this is the expiry, the spot price will be exactly equal to the futures price. So it's as good as settling the bond and the interest rate futures together. The total of the bond and the interest rate futures will be 98.15. That is 98.15. So if you really deliver the bond physically in the interest rate future, both the contract gets cancelled when you sell the bond in this market. This is your gain. .023. That's it. Simple enough. See, in this question also the same thing is done. 0.023. Borrow, then buy the bonds with that borrowing, sell the futures. Deliver the bond. Once you deliver the bond, both these contract gets cancelled at the same time, and then repayment of the bond. That's it. Easy question. Easiest one, yaar. Okay, let's come to question number 19. We'll go fast now. Current futures price is 94.0625. Now the only futures is given to you. This is the timeline, let's say, and the futures price is 94.0625 at this price. Okay, bond 1, 2, 3 is available to you. The prices are given. These prices are at this point. Understand that if you have to settle the contract, these are the prices at the expiry, and the conversion factors are also given to you. Calculate gain to short from delivering. Gain to short. There is some, I think, mistake in framing the question, but what exactly they want to tell you is that you have taken a short position. So if you have taken a short position here, that means you are going to go long here. This is the price at which you will buy the bond, and at what price you will sell the bond. It depends upon the bond that you want to sell. If you want to sell bond 1, the amount that you will receive is the decided price 94.0625 multiplied by conversion factor. So what are you going to do? Just multiply 94.0625 with all the conversion factor right away to know how much you are going to receive by selling every bond. Why selling? This is the buying price, this is the selling price, so this is going to be the sell price. Sell minus buy, sell minus buy. See, 94.0625 multiplied with the every conversion factor to decide what is going to be my selling price, and this is my buying price given in the question itself, 94.25, 126, 142. This is the profit and loss. Now you tell me, calculate the gain from delivering. So we have calculated the gain. This is the gain or loss. If the question asks you which one is the cheapest to deliver bond, I will say this one is the cheapest to deliver bond, the bond 2, CTD. Even though the question is not asking, but still we can solve it like this. Did you have you understood this? Very easy, sir. Very easy. Okay. If this would have been a long position, now if the first part, this would have been a long position, then long position multiplied by the conversion factor would have been the buy price, and this would have become a sell price. At that time the answer would have changed, right? Okay, let's go with question number 20. Suppose that the treasury bond futures price is 101.375. Which of the following 4 bonds is cheapest to deliver? They have not asked us whether we want to buy or whether we have a short position or buy position. Oh, that's fine, we can give the answer from both the ends. Okay, so the very first thing that you want to do is multiply the futures price with the conversion factor. This is going to be either buy or sell to you, this is going to be either sell or buy to you. Okay, let's do that. I think we have already done it here. 101.375 multiplied with the each factor, we have this one. So if we are considering this as a short position, if we are selling the futures at this point and buying it back at the given prices, so these prices are exactly the same, the second prices are exactly the same as quoted price, so we can easily calculate the gain or loss, and every bond is giving you the loss. Every bond is giving you the loss in this case. What is the assumption, sir? The first assumption is we have a short position in the futures. Okay, most of the time this is going to be the case, man. I will tell you, long position in the spot market because you have purchased the bond, and short position in the futures market. So if this is a short position multiplied by the conversion factor becomes the selling price. If that is the selling price and this is the buying price, you have to deduct these prices from the selling one, and there is a loss. If there are losses in all the cases, you will choose the bond which is giving you the lowest loss. So this is the cheapest to deliver bond. You can see CTD bond is bond 4. Why? Because it is giving you the lowest possible loss. Otherwise all the other bonds are giving you higher losses. Okay, come to this point, question number 21 now. In March 2020, XYZ Bank sold some 7% interest rate futures. Sold. Short position again. Underlying notional 7.5% coupon bond. The exchange provides the following details of eligible securities that can be delivered. So exchange has provided the list of securities that you can deliver. See, quoted bond price means the price on the date of delivery. You can consider this as a buying price also, selling price also, but it all depends upon what position you have taken in the market in the future. So if you have a short position in the future, that means the selling price has already been decided. These are now the buying prices. At these prices you are going to buy the bond, and at what price you are going to sell the bond, that futures price multiplied by the conversion factor. Okay. Recommend the security that should be delivered by XYZ Bank if future settlement price is 1000. See, that means the futures price is 1000. Multiply all the conversion factors with 1000. You will get something like this: 1037906 and so on. What are you going to do afterwards? This is a selling price, this is a buying price. You can easily calculate the profit. The bond which gives you the maximum profit should be delivered. Okay, let's come to this point. 1000 multiplied by 1.0370 gives you 1037. Then this is the quoted bond price. We have a loss in this case. In the entire thing, we can see that this bond is giving us the highest possible profit, 6.80 Government of India 2029. Since maximum profit to the bank is in case of 6.80 Government of India 2029 should be opted for. This is called as CTD bond, cheapest to deliver. It's very easy. This was the question asked in a mock test paper of April 2021. So please make sure this is an important one. This can be asked in the exam. So that was all about question number 21. Can we see question number 22? Question number 22 is on the interest rate option. So from this point onwards, interest rate option is starting. We'll take a break and we'll be back with the discussion of interest rate option. I hope you understood the concepts of interest rate futures. Okay, in a summary, I will just explain the interest rate futures, and it's very easy, sir. Interest rate futures are based on the prices of bonds and not on the prices of interest rate. The underlying asset under the interest rate futures is the bonds price, not the interest rate. There is an inverse relationship between the asset interest rate and the interest rate futures. So if the interest rates are going up, the interest rate futures will go down. Theoretical price is 100 minus R. You can clearly see this chart will help you a lot to take the decision. If the interest rates are expected to rise, that means you are the borrower. Interest rate futures will fall and taking a sell position will be easy. Opposite will be this case. Most of the time, 99% of the time, this will be the case in the question. Probability. Let's write down the probability of questions. 90% and 10% is the probability. So out of all the 10 questions, 9 times this will be the situation. Okay. So most of the time you will be taking a sell position in the interest rate future. The standard size is 2000 if it is required. And what else? That's it. This is about the interest rate futures, and then we decided once again about the cheapest to deliver and the conversion factor. If you remember this one, this is enough. This first chart and this chart is enough for understanding interest rate futures. Okay, conversion factor is the factor which you will multiply with the decided interest rate futures price in order to decide whether it's a sell price or buy price. Most of the time it will be the selling price, because again 90% of the time this will be the situation and 10% of the time this will be the situation. So most of the time interest rate futures multiplied by the conversion factor will be your selling price, and the quoted price, this one be your buying price. Okay sir, let's come to the concept sheet now. Now concept sheet explains few things that we have completed till now. We have discussed on the forward rate agreement, profit and loss, and how to calculate. We have seen some formula here. If you remember, it was like notional principal amount into RR minus FR into DTM, days till maturity dy, divided by 1 plus RR into DTM dy. In case of investment, this RR will come here and FR will come on the other side. So then we also discussed about calculating the forward rate agreement. If you theoretical price of the forward rate agreement, if you remember, if we have a 2 years bond and if we have a 1 year bond, then we can easily calculate the fill in the blanks wala part, F2. This is how we calculate F2. Okay, so this was about the theoretical futures price. Then we came to the interest rate futures. You can easily see there is some relationship between interest rate futures. It's like if the interest rates are going down, IRF will go up, and if the interest rates are going up, the IRF will go down. If the IRF is expected to go down, then you take a short position in the interest rate futures and long position in this case. Most of the time you will be the borrower, and in this case you will be the investor. This is how you can decide. And there was something called as CTD and cheapest to deliver and conversion factor. In this case we learned about it. And now we are going to start with the question number 22, which is called as the option. Interest rate option. We have already seen one question on that. Do you remember? Interest rate guarantee. What happens is that when you pay the premium in forward rate agreement, FRA, when you pay the premium, you fix the upper side or lower side, whatever you want. You fix the loss. That's the maximum that you can bear. But you keep the profit side open. So it's all up to you whether you want to exercise at that rate or not. What happens in the forward rate agreement, you have an obligation that once you decide a particular rate, that will be fixed no matter what the spot rate, and you don't have a choice afterwards. But in this case, you will have a choice whether you want to exercise on that rate or not. You will exercise only when there is a loss in the market, so that you will exercise and avoid the loss. And you won't exercise when there is a profit in the market, because when I'm earning profit in that market, why I'm going to use this option? So this option will be lapsed. This is just like call option and put option. We are going to exercise only when we see that we are getting some profit by exercising the option. And when there is no profit, why we are going to exercise the option, right? So we will be looking forward for the type of options. First is the cap option. I think floor option is not separately taken, but it will be included in this question itself. Cap option, collar option, floor option. So all the options will be considered in that. See you after the break.